Hello, hello. I think we are live now. Hi, guys.
Hey.
How are you? How's your week going?
Another day, another dollar.
Yeah, I guess living the dream at the moment. It's Thursday morning here, 12 a.m. So yeah, just another day in Australia, just working with these American guys and of course the people in Estonia and different time zones.
And you, Brian?
Yeah, hi from rainy Estonia today. It's nice to check in. See, I'm 1 week closer to getting the haircut, so yeah, maybe that'll be like the announcement for next week.
That's awesome.
Oh,
It's
fine. We didn't need him anyway.
Okay, but I think we can say hello in the meantime to everyone who has joined us today, and stay with you all. And thank you for joining us. My name is Silvia. I am aka Crypto Empress. I am the CMO of Estonian Cryptocurrency Association. I'm here today to help you get your questions answered and to delegate the fireside chat. Our today's speakers are Jonathan Libby, who is the founder and CEO of Steady State, Akash Mahendra, who is the head of strategy and operations in Steady State, and Brian McCabe, who is the CMO of Steady State. Any questions you have during the presentation of the speakers, you can write them to the stream chat and I'll forward them to our hosts, and we can answer them later after our discussions has ended. So today we are taking an in-depth look at index and coverage pools. But first, we have this new section where we look at the recent news in DeFi, especially hacks, exploits, and a bit politics as well. So DeFi project Popsicle Finance suffered a $25 million attack. And Popsicle Finance's ICE token initially crashed 55% on the news. So a hacker looks to have exploited a smart contract in the platform's Sorbetto Fragola liquidity manager. Fragola allows users to optimize yields on Uniswap v3, automatically choosing the best ranges to ensure the highest yield. However, a bug in the smart contract allowed a hacker to trick the contract into paying out yield from the day it was launched instead of when the hacker allocated funds to it. This resulted in the hacker being able to repeatedly drain large amounts of Ethereum using the same exploit on multiple accounts. In total, it is estimated that the hack cost users approximately $25 million. Despite the exploit, however, investors still seem to have confidence in Popsicle Finance and are buying the dip. So maybe it's time for Steady State to offer them insurance, because it seems like not all hope is lost with those guys. Anyway, we had an even bigger massive hack yesterday happening, where at least $111 million were stolen in a cross-chain hack. So a cross-chain protocol, Polo Network, has been hacked for $611 million in the largest DeFi hack to date. The assets stolen were $273 million of Ethereum tokens, $253 million in tokens on Binance Smart Chain, and $85 million in USDC on the Polygon network. Some of the money has been returned by the hacker, and you can keep an eye on the Twitter account Woo Blockchain, that is WU Blockchain, which is giving updates on this situation as well. But what do you guys think? Do you have any opinion on this huge hack that just recently happened?
So yeah, I can start, Sylvia, and it is actually pretty amazing, like what's happened over the past 24 hours, and everyone in our Steady State, and I'm sure many people across DeFi have been really following this one very closely, because it is quite interesting. So basically what Poly Network does is that you can access decentralized finance networks across 3 different blockchains. That's Ethereum, Polygon, and Binance Smart Chain. And this interoperability relies on a complex code, which essentially created an opportunity for an exploit through the ETH chain side, and the hackers got access to the private keys. yeah, no, it's probably the largest hack in terms of US dollar values, and there's been quite a lot of epic heists, these kind of hacks and heists since the Mount Gox days, but this one I think tops them all.
Yeah, it's wow. It's kind of just one of those things you can look at like, wow. I look at that hack and I see it was a multi-chain hack, somehow the check on the multi-chain hack. I think it was related to the Ethereum node or the Polygon node. But one of those bugs got exploited that allowed them to translate to all of their chains. And that was just like, how do you even understand that happened? Like, it's just one of those things like that. Has that happened before? And that's something we're asking and looking at ourselves, and thinking, how do you prepare for something like this? Because the future is multi-chain. The future is not going to be necessarily on one chain, I believe personally. I think if we're going to see systems evolve and chains and layers find their own niches. And so when you think about that, multi-chain and understanding the risk of multi-chain is something people have to really start considering, especially after an event like this. And we have to really begin thinking about that and how these kinds of risks can become understood. These different bugs relate that because of one bug, it wasn't just one chain. It was, I think, 3 chains impacted by this system.
Yeah, so what John says is true. We really have to kind of dive deeper into these kind of hacks. Now, it didn't affect me personally, but this is real money. There's a lot of people very unhappy and now even scared across DeFi space, and this is like a serious cause for concern. This is a kind of event which erodes confidence in the space, not just from like institutions and hedge funds, or other people who want to enter in the future, but just the people itself. Like, I consider myself a degenerate farmer, liquidity miner, but now even I've, this is the first time I've personally started thinking like, oh wait, maybe I should just put my money in something more secure, such as a yield app, or something a bit more centralized, because they'll have more care. They'll have their own sort of centralized insurance fund kind of thing for to cover the losses if that happens. So yeah, it does get people thinking, and this is quite a serious event, and this event will have some repercussions. And it is notable that it's right in the middle of a regulatory commotion in the American Senate. So who knows? Maybe that might get brought up there as well.
Yeah, I mean, like, logically thinking about it, guys, this is one of the biggest bank heists, I guess, in the world, as we were saying earlier. And like, if you think just physically how much space $600 million takes up, that's quite a lot. I mean, I think like 1 billion is supposed to be something like 20, 30 washing machines of weight. So like, this is something potentially that can only happen in this world, and maybe only will happen in this world, because I was like thinking the topic as well, like if we're talking about central bank digital currencies and all this coming out now, I mean, what happened with Tether, or the Tether portion of this hack, was essentially frozen, and more or less like the transfers can be reversed. But it's always going to be an interesting topic in DeFi, like how are we supposed to handle this too? Because some people very much think that crypto is censorship-free money, and if you're hacked, essentially you maybe didn't have good enough security, and that's the price you pay for having it. So like, there's a lot of conversations that are going to come out of this, whether it's a need for more maybe regulation or like more monitoring of transactions to like potentially stop this happening, or whether we need to ramp up audit security to stop things that, like, clearly there is quite a few solvable bugs creeping through. So I guess the question's got to move, like what's the best way to cover for this? Obviously insurance is one pillar of this as well, so it's going to be very interesting to see which way things go, and I can see a lot of different viewpoints and ideologies coming out already regarding it.
Wow.
You want to add anything?
This is how code works, you guys. It's all logic. It's all writing. When you think about how the functionalities of Poly worked, it basically a lockbox of funds. So if I put $100 and then it would like somehow move monies to other chains, and allow it to like appear in other chains to aggregate yield. Basically, how the money was pulled out of these lockboxes. How money was pulled out of these lockboxes is basically there was some kind of like a bug. Like they're not a bug, but there's like there's an agreement on the code where there are people called bookkeepers, and they would, when basically the only way funds can be initiated to move from this lockbox where all the funds are moved around back to a person is when the bookkeepers have to actually approve that network and say, remove these funds to this person. The hacker was able basically to find a bug in the code to make him the bookkeeper and basically say, I approve, send all the money to me from this whole fund, not just like whatever's owed to every wall in the breakdown in the structure is all the money. And that's kind of how it was stolen, is he literally was able to break in and actually, and that came down to the keeper's code. The keys, there were only two, and you only needed one to validate. So if you got access to one of these keys, and apparently they were armored, but I'm not sure how they were armored, then you could label yourself as a bookkeeper. Or if you could find a bug in your code and place yourself as the bookkeeper key, you could easily take all the money. And that's kind of what he did. It's very, very interesting. He's a lot of intelligence there, but apparently, thank God he's never heard of Tornado Cash. But
yeah, no, exactly. And yeah, just to finish off here, on a broader scale, we think of crypto as the crypto world itself, and the blockchain tech as something which will solve all the problems that we have in the current financial markets, because it takes out the middleman who can be, corrupt, or they have their own sort of, they can be compromised in different ways. But we've got to remember what John just said as well. Like it's all just code, which is written by people, and people are infallible. They'll make mistakes. They're bound to make mistakes. So we're going to have issues, especially with this kind of industry where we're having, breakneck innovation. There's a new product or new sort of idea which gets dropped every day. So we're going to have issues. This Poly network was backed by a lot of significant players in the market. It was audited, but things just are bound to go wrong in this industry. And look, this is where steady state and general DeFi insurance comes in. Like we need to give confidence to. It comes back to the same point we've been talking about last couple of weeks. We need decentralized insurance for protocols to give confidence to institutions, hedge funds, other individuals who want to enter, and even the people in the current market. As I said before, I've been sort of having to think about where I put my funds now. But before yesterday, I was like, this new protocol, fuck it, I'll put it in there, and sorry, I'll ape in there and put some funds on, and see how it goes. But now it's gonna make me think twice.
Well, thank you, guys. And lastly, we have a news from the legislation side. So SEC charges DeFi lender and its executives for raising $30 million through unregistered savers. So according to a recent press release, the executives allegedly used smart contracts to sell two types of tokens that the SEC considered securities. More precisely, those were M tokens, which could be bought with specific digital assets that paid out 6.25% interest to investors. This lawsuit marks the first time that SEC goes after a DeFi protocol. Keo and Acri will have to pay fines up to $125,000 to the SEC. They also agreed to pay $12.8 million in disgorgement through a cease and desist order. Both executives settled the case without making any comments on the accusations. However, legislations and regulations are definitely something to keep an eye on, because they're coming either way and should not be ignored. But now let's move on to discuss B2B, or business-to-business insurance in DeFi. If we take a look at Unslashed and others, what do they offer, and how is Steady State different from them? Brian, for example, could you please give us the summary on that?
Yeah, well, as we started out, like other players in the space, like Unslashed and Nexus Mutual, initially their offerings were like individual coverage. So recently they started to branch out into like the B2B space and making business policies, because obviously when Nexus started, people start to realize, okay, there's like more than just a demand for individuals to cover this, but people and institutions want to also cover specific risks they may have. So I would say that like they've come onto the market, they've more or less expanded their offering, where we have come in to specifically like cater for business needs. It's not to say that we're not complementary or we don't do the same thing, but yeah, I'll let Cash and John go more into the specifics on the details, but it's quite a big market for B2B insurance. They've recently launched like a Spartan bucket, which would be quite a similar thing to our index pools, where they essentially want to put insurance contracts for several different projects into one bucket. And then as an investor, if I want to essentially offer or stake my ETH to provide coverage for these protocols, I can essentially put my ETH into this one bucket, and I can be exposed to 30, 40 different policies, which again reduces my risk and also increases my sort of exposure to several projects in DeFi. So this seems to be a model which is gathering speed in the B2B case. We're building out our project based on that, and that is the main focus. So I guess you can say a compliment is something to see, you know, to us, that everyone's interested in the space. And yeah, I'll let the guys speak more about just how we actually want to build out the exact differences here.
So I would say when you look at the B2B space, it's very, very early. When you say Nexus, these branches and let's say on Slash, these Spartan buckets, here's the problem with putting your money into a pool. They how they develop and build it with like one pool is connected to multiple different policies. Is the goal is to, again, what we kind of our model of building diversified returns. But the problem is when you put money into the system is if a payout, the process is still an indemnification. So basically they evaluate the loss to a protocol and then create a payout. So you're still at total risk of losing 100% in these kinds of pools. I would say what separates us is we actually weight the pool loss percent. And therefore you can only lose a certain amount on an event happening, rather than you're still at risk of losing 100%. All protocols on our index pools would have to file for insurance, or have to have an insurance payout in order to lose that, and that's incredibly low. That I would say is a big difference. Unslashed, and they're making a B2B focus. It's all focused on indemnification, creating very large pools, ideally extrapolating those pools and trying to get create a payout on those pools. There's a concern with that method, in my opinion, where the stakers providing the capital, not necessarily one entity. And because of that, it is in my view or my opinion that if you keep with these pool models where you don't weigh the downside risk, you're always at risk as a staker and losing 100% of your events, or 100% or a very large amount of your assets at an uncontrolled manner, which therefore makes you uncomfortable with any system to provide that kind of capital. Our system, what makes us different is weighing the system payout. Is kind of like actually weighting the loss, or weighting, if an event happens. So it really controls it. And that's the downside coverage we provide with our index pools. That would say at a high level compared to the other industries. Sherlock DeFi, I think, is another one doing the indemnification approach. Again, they're trying to use staker money. A lot of staker money to cover the loss of protocols. The assumption here is they have to collect a bunch of premiums from a lot of different protocols and create the premium payouts, and somehow take a rate of return premium to a pool to increase their portion or size in the identified pool. Again, the policy size you're dealing are $20 to $30 million. And here's what's going to happen with these pools and these B2B systems is either you're going to create the payout the protocol suggests, that your analysts suggest, and therefore a lot of people staking their assets in your pool are going to lose a ton of their money. Okay. And then they're not going to be happy with the system. Or what's going to happen is they're going to have to create a payout, and then they're always going to be paying these premiums out to people, and always taking from their portion, which will never allow the fund to actually grow to create them to a scalable model. Or they're not going to pay out the protocol. And when they don't pay out the protocol, they're not going to be happy with the system and look for a new model. And so that model actually, in my opinion, sets you up for three kind of pain points that are really hard to overcome as a whole. With our model, we actually acknowledge the risk. So we cover B2B insurance, and we have the harder time scaling coverage collateral into a larger system. That's our pain point, but we can go over that later. We actually try to control the risk of the staker, and we prioritize the staker while also creating a customizable coverage policy for the protocol. By telling the protocol you're only covered for what you're collateralized for, it allows them to know how much coverage they have and what they can do with it. And by creating these index pools that actually weigh the downside risk and not only like unslashed in the Spartan bucket create the diversified premium payout, we actually control the downside as well, which makes our method a little bit of a stronger system for protecting the staker while also incentivizing more money to be staked into the system, which allows more capital provided to be distributed to multiple different coverage pools. And that's, I would say, would really separate our model from a lot of the other systems. Ideally, we'll be collecting fees as well into our system. And longer term, we can create our own pool, our own system where we can actually invest in our system. And long term, if the DAO wants to grow and build the system with us, we can offer a model that indemnifies as well with all these other systems, ideally, and share the fees of the protocols. But these approaches are typical kinds of insurance that you would see in life, health, and property and casualty is what the approach being taken by Sherlock, and I would say honestly Unslash too. Our approach is actually following another model called reinsurance captive insurance. The reason why I think this model makes more sense for our system and actually able this whole is alternative insurance. We're in an alternative finance market of non-understood risk. We gotta rely on cutting edge and alternative measures to actually understand and protect our people and our communities. And that's actually what separates Steady State, I believe, from everyone else. Is our approach at a fundamental level is different, but because of how we build this out, it allows us to long-term scale while offering the collateral and actually allows us to be customizable in our own system and create different options for protocols while protecting and offering different opportunities to users.
Yeah, I think honestly, John said it really well. I'm not going to elaborate on too much on his points. And of course, Brian also outlined the entire thought process behind changing the narrative from the retail people getting their own insurance to each protocol insuring themselves, and allowing a new entry for institutions and essentially pushing DeFi forward. So Sylvia, I just want to add one point. One of my favorite features, which I am looking forward to playing practice in Steady State, as compared to the Nexus Mutuals or Unslash or the other protocols that are currently available, is the claims process, essentially, which is currently it's slow and subjective for people like companies like Nexus Mutual, and the risk assessment may also have different biases. So Nexus Mutual, for example, they essentially reward mutual members for assessing votes on claim, and this can convolute the process and introduce a host of potential biases and errors. We have an automated claims process. It's we can go into detail for hours and hours about this, but this is what we're building, and it's going to sort of inspire more confidence that it's not going to be based on some subjective people who have a conflict of interest in the protocol. It'll be done through automated smart contracts, which is essentially the entire point of decentralized finance, which doesn't rely on middlemen or subjective people involved in the entire process.
Well, thank you guys for this very in-depth explanation. Very good, very good. So our today's topics are coverage pools and index pools. So firstly, let's say coverage pools. Akash, can you give some more insight on, because with steady state DeFi protocols and CeFi platforms may create customizable insurance policies that are crowdfunded from individual users. So why is this needed, and what sort of problem this solves?
Sure thing, Sylvia. At a very basic level, so custom coverage pools are essentially a type of a liquidity pool which locks capital assets which are staked by users as insurance capital or collateral for a predetermined length of time. However, what we're doing is changing the model a little bit. Steady state's coverage pools will have three main distinguishing features, which is they'll be customizable, they'll be fully collateralized, and most importantly for all the users out there, they're going to generate multi-yield rewards. Now, the customizable part is kind of hard to explain. I mean, well, it's not hard to explain. It's more sort of suited towards the protocols themselves, because rather than cramming all prospective policyholders, which is essentially DeFi protocols, into ill-fitting insurance contracts, we're going to allow each contract to be tailor-made to the protocol's individual needs or preferences, and this kind of customization will allow people to adjust the contract parameters, such as the policy size, the term length, the scope of its coverage, perhaps, to really make sure that the insurance policy that they have is suited to their platform, and not just kind of one size fits all sort of thing. But yeah, one of the things that really stood out to me when I was speaking before I joined the team, and I was speaking to John and people who were the ideas behind this one, was the multi-yield reward system. So not only will if users who stake into coverage pools get premium payouts, but they're also going to get shield mining rewards, which will be the native token of the protocol they're insuring. They get risk token rewards, which is our own native token, and of course asset management rewards. So which when they stake funds on our platform, we'll be able to reinvest that into different protocols, and through on-chain contracts, and of course give them a further yield.
Super cool. I'm so excited already. Like, I feel like I want to put my money into stuff, like, because it seems so much safer to just because we as we see the hack that just happened, and just it's way safer ways where I can trust and put my money. Do you guys want to add anything else?
Just cash it perfectly.
Yeah, nothing in particular. I mean, one thing, I don't know, I like to bring up questions live and just test the guys here too, but one thing I haven't fully finalized, and I don't think because we've just started building the product, is how are we going to, when it comes to coverage pools, if someone wants to take coverage, I mean, it's going to be a process where they work with us, we start to write out a custom policy, but even from a marketing perspective, we have people can come to us, we can start talking in our community about potentially if we could provide coverage. There will be a process for how this sort of starts, who's going to initiate, but I guess we need to work that out on a sort of client onboarding side. If you want to make a policy, here's what we want from you, potentially here's what you can provide us, here's how you can sort of influence your quote that you eventually get. Some of this technical stuff we need to work out on our side, just when it comes to the actual nuts and bolts of putting together this coverage pools for protocols.
That's awesome. Okay, and besides coverage pools, we also have index pools, which is Jonathan's favorite topic. So could you share some more insight on index pools, since you love to talk about it, and how protocols may pool funds together to create a shared policy, and so on?
Yeah, I kind of talked a lot about that a second ago when I went over the Spartan buckets and what separates us from them, and why I think it's a better measure to scale and actually attract more liquidity and capital. The index pools are actually in many ways just a derivative. They may it's just a concept financial concepts. It follows more a lot of derivative finance concepts where it's basically a pool, and it's honestly just a pool representing your exposure to all these different coverage pools. The problem I always say with investing in a coverage pool, let's say you have Aave. Aave promises to pay a 10 or 20% rate of return somehow on some kind of value to the Aave token. Okay, so basically that's Aave. So Aave basically is Aave wants to pay a 10-20% rate of return on Aave token, and so kind of what the coverage pools do is basically I can take $100 here and I get say of USDC and I get a 20% rate of return on Aave tokens. The upside is a 20% rate of return on Aave, downside is 100. But if the event happens, my loss is 100%. So that's not a good bet in my opinion. So these index pools, what they do is it's just a pool representing weighted exposure to multiple coverage pools. and that's all it is. So when these coverage pools work is that I put $100 in this index pool, say it's exposed to the coverage pool of Compound, Aave, Yearn, Yield, and all these different protocols, let's say 10 different protocols at a 10% value. Well, then if an event happens, my loss isn't 100%, it's 10%. And the odds of, say, 4 or 5 protocols in a very strong market cap index actually having the insurance payout is so low, I can actually find opportunities to profit on the downside risk. And so that's kind of like what the index pool is as a whole is. And what it does is if I put 100 USDC in here, I get a stake derivative of 100 USDC. And that stake derivative receives all the premiums. How this works as this derivative stake on the coverage pools as well as the index pools is the problem we see with a lot of the crypto markets and DeFi markets is for insurance protocols is if I want to unstake my capital, it takes 7 to 30 days to unstake my capital. Whereas if I have versus if I have rather than how we're doing it is you can trade the derivative. So if I put 100 USDC in here, I receive a synthetic 100 USDC. And when I receive that synthetic 100 USDC, I can trade that in a secondary market. And I can actually, like on Uniswap V3 or Sushi, or maybe some brokered KYC accounts as well. And basically what this allows me to do is it allows me to actually make my stake liquid by buying the downside risk and actually making it tradable in the secondary market. And so these index pools are meant to be powerful tools to actually allow more capital to distribute between more protocols, while actually creating one of the first liquid tradable risk token markets that you can tell if an event happens, what are the likeliness of moving 5% value, be able to trade around that value. Whereas when I move it back into the station system, I can redeem the synthetic USDC for multiple different tokens. And that's what I think makes our system really valuable.
Thank you for this explanation. Also to our viewers, in our first steady state chat, we also discussed index pools and coverage pools. So you can check this live fire chat out as well to get more insight on the coverage pools and index pools. But let's move on. So trading PI tokens, what is it exactly, and what sort of solution it offers to liquidity provider rewards program? Brian,
actually, I wanted to ask John a question about this now, because where he was going with the previous topic leads into this exactly. So, I mean, when you consider our competitive advantage against maybe some other platforms which allow you to stake and underwrite protocol insurance, I mean, generally you have funds locked up for a period of like 3 weeks, maybe 4 weeks to provide continuous cover for the duration of the policy, right? So, I mean, just taking in the case like what happened yesterday, there was like a really big hack, potentially Poly Network. We don't know right now, are they good? Are they not good? Is the hacker returning the money? Is he not? So like, I guess where we're going here is like, if we had our funds on steady state, I would have like Poly tokens, which would essentially allow me right now to get my stake out of that policy. Maybe right now people think it's 50-50 if the hacker is going to be returning the funds or not. So potentially I could get my 50% of my insurance stake back, because that would be essentially its value, right? I mean, when it comes to actually product use case, this is a bit how we essentially make the market more different, if I'm correct.
You're absolutely correct.
Oh, cool. Right in one.
Yeah. And that actually, yeah, you can actually see the power behind that as a trader, betting and arbitrage opportunities. This doesn't eliminate the fact that, it doesn't eliminate the fact that we need to keep identifying, protecting, and building our communities by when a hack happens, trying to figure out what the heck happened, like with Poly Market. What this allows is, an extra layer of coverage for the teams or the protocols, so we can actually recover, recruit, and it allows an extra layer. So even after that, we can protect communities, but also it's like it becomes a kind of a new betting market, which kind of gets really interesting. And your betting value, say a 60% chance, 50%. Using Uniswap V3 composability these are V3 and the price action on liquidity flow. We can actually now like make this market composable and actually be able to trade these markets like based on kind of a 10, 20, 30% speculation. And there's opportunities for arbitrage profit, which makes it a really attractive industry, I think, for a lot of traders and industry people. So it becomes a safe bet with the index pools. But say you have a 5% loss window on but you're getting a 25% rate of return, let's say, and all these tokens. Well, you can trade that 5% principal value around to find out, likeliness. And maybe you'll keep 100%. Maybe you'll lose that 5%. Maybe we'll get 2.5%. That makes it really interesting, I think, as well.
What makes this whole industry really interesting to me right now is I was just thinking I love thinking about the psychologies of hacks, the reasons behind them, why people do them, if they're real, if they're not. I mean, this is the business we're in. But I was just thinking of this play that if I was the Poly network hacker and we had a system like Steady State right now in operation, yesterday would have been a great time to buy all those Poly insurance tokens when they were trading at 1% value, and then say, oh, I'm returning the funds, guys. Never mind, insurance won't be needed. I'm potentially opening up this, as you said, it's a market for risk, and we're ultimately not talking about the dynamics of how this market, but just theoretically speaking, I mean, there is these markets exist in TradFi. Every kind of risk can be covered. I don't know if the same kind of exploit could happen because of the anonymous nature of DeFi, but I just got my head spinning there, guys. That some things which we never know are possible suddenly become possible, and that's essentially what DeFi has been the last few years too. So, sorry if I made anyone's mind explode. I'm just the realms of possibility when it comes to what you can do here and how insurance risk, everything can be put as a commodity is. Sometimes I still get blown away by it.
Look, Sylvia, these guys covered it quite well, but as I explained before, I love getting in DeFi and just playing around. So this liquid secondary market is really important for people like myself, or I think Brian also loves investing in DeFi projects and also just playing around there. So it gives me the ability to instantly exit a pool with minimal loss, or I can increase my risk right away by swapping PL tokens from one coverage pool from PL tokens to another coverage pool. So I think this whole maneuverability is really important in DeFi, and this is what the secondary markets gives us. I think if we build this out right, people will be fascinated by what we have, because no other insurance protocol allows us right now, and maybe that's one of the not even maybe I'm sure that's one of the reasons why DeFi users don't like investing in insurance protocols, because you lock your funds up for a month. It is a bit frustrating for someone. I kind of like Nexus Mutual. I've been involved in the community, and I still have money on there. You have no idea the hoops I have to run through or jump through, whatever it is, to get my money out. So I've got my NXM tokens staked on the platform, and it's a decent rate of return, nothing fantastic. But to get it out, I have to wait 30 days to unstake. I've got to each protocol. I mean, of course, the other issues, I've insured each protocol separately. So when the gas fees are high, it's just insane. So it takes me about 30 days or something to access my funds. Kind of have to wait around. If a new protocol is launching, I won't be able to jump into it right away, because I've got to wait for a long time for my funds to come out. So it's not ideal. Look, it is what it is, and I know they're well respected in the space, and I have a lot of time for Nexus Mutual because they were the pioneers in DeFi insurance. But innovation is the key to moving the industry forward, and without steady state solutions, look, I don't want to list all of them, but one of them is the liquidity secondary markets, risk assessment database, automated smart contracts, automated claims. Without these innovations, there's just no way the entire insurance industry and the DeFi space as a whole will move forward.
Yeah, I mean, just as Akash kind of said there, inertia, everything, water flows the path of least resistance, and if it takes a month to get your funds out of some protocol you regret insuring or providing cover for on a platform like Nexus, then essentially, if you wanted to be on steady state, you say, okay, I think this is a protocol which is safe. I want to put my money there. I can do it in 1 hour as opposed to a month. And I guess things in DeFi and in crypto, people always want what's optimal, what's faster, what's more efficient. So I think if we keep building it this way, it will come.
Thank you very much. Do you want to add anything, Akash? You look like you were about to say something. Okay.
No. I think it's just I mean, packaging risk in in what we're doing through index pools and then putting it into the secondary markets is akin to some very significant traditional products, and that's a really exciting part for people who are the institutions or the hedge funds or the even the traditional insurance companies which want to get into the space. That they can do this through our system, because I don't know what I can say, what I can't say at the moment in relation to what we're building, but or who we're speaking to. But it's what we're doing is it's gonna be very exciting for the traditional and the DeFi insurance space.
Well, revolutionary. I say it every live. I have to say it this time as well. It's revolutionary.
Oh, fingers crossed. I mean, that's why we're here. Well, we wouldn't be here if we weren't, building something which we're really proud of, and something which is going to hopefully change the market for the better.
I'm excited. Thank you very much. But lastly, tell us a bit more, guys, about the implications of index and coverage pools. For example, institutional interest, safe haven assets, etc.
Well, so these index pools, we still don't know how to protect this space. No one in the industry does. What we're using is standard methods, but also cutting edge. And we're using, like Cash said, structured products that have precedent and are known by institutional funds and hedge funds. I think for institutions, a steady state index pool structured kind of product-based system would be way more attractive, to let's say an investment fund than necessarily getting involved with a protocol in DeFi. The reason why, like Curve is a great system. We love Curve. But you never know, what happens if Curve gets hacked and you lose all your money? What's going to happen to your money and your investor money? Rather than trying to avoid all the downside risk, rather than trying to avoid all the, the likeliness of getting hacked is so low, we actually accept and acknowledge the likeliness of it then happening or hack happening. We acknowledge it and we control a good payout and a really good payout for it. Every institution has a portion of their portfolio dedicated to speculation, and part of that speculation is based in fixed income or CCC bonds. CCC bonds have a very high default rate, and by actually controlling the default rate, rather than having a high default rate, say I'm getting 5% at a chance of a 20% default just on speculation, why not control and weight the downside risk and maybe accept a 5% loss, but create a 25% payout, creating 5-10% arbitrage? And that's the high level of what we're trying to do. Is I think for institutions, they have these speculation, they have these CCC bonds. They are actively looking for higher yield on these bonds because they're so low right now. You look at, I think, IRS law 7702 or 4. Obviously, I don't want to get into IRS law, but basically every insurance fund portfolio is looking to get out of all their, a bunch of their bond positions because the yields are so low and they don't know what the heck to do with it because they're long-term holders on an investment and they can't get an optimal amount. By creating this is actually an attractive way to gain yield and exposure to a new market, and while also controlling your downside risk. We think this will be a very attractive play for institutions to actually buy the downside risk of the average DeFi individual. If you're a trader, and you don't know what to do with your capital, why not park it here if it's liquid and you can resell it? Why not park it? This is basically a play, for a new kind of, financial products for DeFi and crypto. So this is what it's going to do is it allows a lot more game theory applications for protocols, for communities, for traders, for whales, for even institutions, we think, as well. And that's why we're kind of focusing on showing the customizability and opportunities for everyone. A protocol, I can buy my own downside risk and offer arbitrage profit opportunities in my communities. If I'm a community, why not buy their own downside risk and arbitrage my profit on the downside if an event happens? If I'm a whale, I know if I put any of these money in these protocols, I could lose it. Why not park capital here, acknowledge the downside, and accumulate a ton, ignore the market, a bear market, everything's down, and just accumulate. Imagine getting a 20% rate of return, 100 tokens, and it's liquid. I can access them. I can move them out of my system and just sell. That is powerful. And that is what we're trying to build. If a trader, park capital if you don't know what to do, and then resell the capital. Or even just trade the arbitrage. This is going to be an opportunity, not just for the protocols, for all of DeFi to get a new opportunity to find for growth on their assets and in the space. And we're really excited to see what this can do for everyone.
Yeah, I think
Did you freeze, Brian? Yeah, I think you did.
That's a good face right there.
No, yeah, the scope's big. I don't need to add anything else. I think Johnson covered it best. The scope is pretty amazing. It just depends on how we go and building it. Like if we build it right, we'll it's going to be pretty amazing. But yeah, it's a long road ahead, and we're committed to working hard for the long term. We're not obviously. We're working with working with a lot of our strategic partners, advisors, getting a big dev team on. So yeah, it's going to be a long road ahead, but something we're very excited to work on day by day.
Super cool. Thank you for this explanation. And we also have a question from our viewers today. Let's see. Paulo Coelho, I hope I said it right, asked, what do you say to lawmakers who point to this as a reason DeFi crypto should not be trusted? I think he means like hacks.
The poly hack, yeah.
Yeah, and how can steady state concept relieve those concerns?
For the poly hack, you're going to point at that and look at okay, the system can't be trusted. Guys, I mean, people were saying that with telecommunications, people were talking that with internet. We're in the Wild West. We're in an early industry. Yeah, we want to control it. Yeah, regulation is not a bad thing. We want protection. We want to protect people, consumer rights. Just like the internet, there are a lot of spammers and there are a lot of hacks. There are a lot of viruses and a lot of opportunities to really do theft, ransomware. There still is, but there's a reality here where how this gets fixed is by letting the industry perform and play out. And also being involved by protecting consumers. Like we are seeing an action play that we actually are taking care of our community in the sense where we identified the event. We know who the hacker was. We have information, and imagine, we could deliver that to people and protect our consumers. That, in my opinion, is making point to the consumers is yeah, there's a reality here. We're all at risk, but we're all at risk for using the internet. We were all at the risk for telecommunications. We were all at risk for, this is what happens when you're cutting edge technology. Rather than complain and say it's a bad thing, saying, okay, how do we actually protect people in a positive manner without stifling innovation? And the legislators, it begins first with educating and understanding. I spent quite a few days on DC a couple days ago, and I was talking to a lot of different people, congressmen, senators, lobbyists, talking to a lot of different groups, and they're all agreed. How can we, I talk to a lot of guys who's I don't know what I'm doing, man. I don't know what I'm supposed to talk about. I don't even know what this space is. And that's what I kept getting across the board. It's educational. And we got to understand, if this is the new internet, if this is a future, rather than looking at it as a place opportunity to say this is bad, see the positives come out of it. We've identified the event. It's all in public information. We know who the person is. And seeing, okay, we are actively protecting consumer rights ourselves. And at the same time, this is the cutting edge. This is the new internet. It'll come in time. And, we can offer protection in time. It first begins with educating yourself in the space. And that's where the focus and idea should be, is getting the people involved that want to educate. And how steady state relieves these concerns is we offer another level of consumer protection for individuals by protecting the protocols. When it comes to game theory and individual and risk tolerance, people talk about the individuals have a good understanding of their own risk tolerance. Maybe not. There's a lot of controversy there. What I can tell you is protocols definitely understand that. And if we can create a demand that protocols get protection and get actually coverage, what we can do there is we can actually offer them a base layer disregarding a member's risk tolerance and just get them the base layer of coverage. And that's what we're trying to do. And that's what we can show to like different legislators is what we're doing is like we're protecting communities. And we're using innovation and opportunity here to protect. You know, one of the conversations we constantly have to have is, are we going to build this in the US or not? And is the US going to be welcome into innovation and all these opportunities for us to build a better future for Americans and for the world? And you know, that's what we want to do with steady state. We want to make a safer, better future for everyone. And if we can't do that here, we'll do it somewhere else. But I'm really hoping the U.S. and legislators see what we're doing, understand where we are in the industry as a Wild West, and what we're trying to do to create a safer world for everyone, and how they can't stifle innovation. They got to expand it if we want to remain the leaders of the free world.
Yeah, and you know, just to touch a little bit more on regulation. You know, we're pretty serious about all this stuff. We have a couple of people on the risk and compliance team who will probably get on a bit later on the show, maybe in the coming weeks. You know, they're exploring different approaches to regulation and all the concerns with attorneys both domestically and overseas, just so we can bring this product to market in several different jurisdictions. Look, Sylvia, our top priority has always remained, you know, is to remain compliant where we and where we differ from the other protocols that I mentioned is that we're an open and honest business, and we're not in the business of defrauding anyone. Communication compliance is a key priority at steady state, from top of our leadership to our most junior level staff, and everyone in our team understands the importance of this, and we share knowledge across the company as we develop.
I definitely agree with the part that the legislators who are setting the rules should definitely educate themselves on this topic, because from my experience as well at the Estonian Cryptocurrency Association, we get like they want to know our opinion from Europe, like part of the world. But if you see the documents, you kind of understand that people don't really even get the whole idea, like what is crypto, what is blockchain. They don't even have any clue here in Estonia what is decentralized finance yet. They don't know anything about NFTs. So how do you really like regulate something that you don't even understand? So I think that's very important that they get this information, they learn it, and they know how to like regulate those things. And it's great to hear that Steady State is doing everything according to the law.
I still don't understand euros.
We also had one question coming in from Mark Snowdon, who asked, favorite influencer to work with Steady State?
You Empress. I'm kidding. You know, we really appreciate all of you guys, you know, all the influencers we work with, whether it's yourself, it's Josh Cross, Girl Gone Crypto, Coach K. We've really appreciated working with all of you guys. And I haven't, you know, Satoshi Sean, we've had really positive experiences with all these different influencers we worked with and talked with, you know, Yield Hub and Kids in the Blockchain. You know, it's very, very positive. And you guys are all great, and we're very thankful. And, you know, our favorite influencers are the ones who buy on the opportunity, not who the ones who are not going to shill a coin for us to take a shilling. It's who are going to buy on the opportunity of what we're trying to do to make a better community for everyone in the world, and ideally long term. And, you know, that's what those are the influencers we love, are the ones who buy into the mission and our vision and what we're trying to do for the future of crypto and DeFi and bring it mainstream. You know, and that's kind of those are my favorite influencers.
Anyone wants to add anything?
I'm going to add a very non-standard answer, but actually my favorite influencer right now when it comes to what we're doing, what we're building, would be Janet Yellen. Why not? Because like John was pointing out here, it's an answer, but like people are looking for yield. If you're holding dollars, if you're an institution or a bank, you're sitting on money where you cannot make yield. At the same time, no banks are really trusting to lend money right now. I mean, I followed the TradFi quite a bit, and I was seeing like last week, there's this thing called overnight repo, which is basically where banks give their money to the Federal Reserve overnight for a tiny amount of negligible yield, just because it's safer than lending it out to institutions, so on. So like the fact that there's $1 trillion of banks just giving their money overnight to the Federal Reserve to get 0.0005% interest is freaking scary. It's telling me there isn't a lot of trust in the world when it comes to Jerome Powell. Yes. When it comes to TradFi. And I mean, we have all these institutions, insurance funds, hedge funds, pension funds, and they have the same problem. They don't know where to get yield. And as John laid out earlier on, I mean, yeah, this is what we're offered to offer. You can get into DeFi, expose yourself to all of this nearly in one go, and get some much better yield than you would get from Jerome Powell.
Good one. Anyone wants to add anything? Or not? If not,
I don't work with influencers personally. I think Jonathan usually goes on these shows and does videos, which are great. Check out our channel. But I've had a few calls with Coach K offline, and he seems like a great dude. You know, it seems the kind of person you go down to the bar with, you know, have some chats, and yeah, you know,
I'm going out to the bar with Coach K tonight. So cheers to that.
Fantastic. Yeah, no, it's you know, it's just kick back, just straight shooter, which is really entertaining to be around him. And he's got a lot of stories from the space. You know, the things you don't really hear about in the news, and you know what goes on in the background. You know, what the VC rivalries are, that kind of stuff. So yeah, it's just good having a chat to him.
That's awesome. But thank you. I think we have made it to the end. Many thanks to our speakers, Jonathan, Akash, and Brian. And thank you also everyone who tuned in. See you all next time. If you have more questions, make sure you join Steady State Telegram. You can QR the code from here from the screen as well. Oh, wait a second. We have one more question. I think we want to answer that as well. Global X asks, do you guys think many protocols that hacked can trigger people to insure their assets? I think so.
If I understand your question correctly, you're asking if we see a lot of protocols getting hacked consistently, if people can insure. It'll always come down to risk tolerance, and some people have different risk tolerances. I remember we did a lot of customer research with Yield app and what's preventing people from depositing more money in Yield app. And they have a great investment strategy. They have a great group. They're doing everything they can to protect their people, their community, and the one thing keeping people from putting more money in is asking the question, are my monies protected or insured? And you know, there's an expectation that Yield app is doing it, which they are, over themselves individually. So I'm not sure, honestly. I think it really comes down to human nature and our expectations. You know, we expect people to take care of us over others, and even though we want individual sovereignty, I think there's some kind of a nature there where we sometimes we have trouble accepting our own faults, and that's whether it's good or bad. I don't know. But will a lot of people trigger? Maybe, maybe not. Is there enough capital provided? Well, if there's a lot of events happening, people are going to move capital from these mutual systems, whether it's Nexus or ours. So I think ours are these weighted risk systems. If we can actually value the risk correctly and report it on a public system, and you can actually see risk-grade return and arbitrage opportunities, hopefully it'll keep them more attractive. And that's kind of our plan, you know, because people always want betting arbitrage opportunities if you're a good trader. And so that's what we're going to try to build out in our system. But if there's a lot of hacks, you know, you're going to want to weight the risk, and the premiums are going to go up dramatically, and people are going to pull capital out. So it's all about controlling the system and seeing how they balance out. You know, the best kind of risk protection is kind of like what Connor said, I believe, it's make better code. And that's the goal. You know, we're trying to get there. It just takes time.
Well, thank you, Jonathan. Do you want to guys add anything? Nope. But thank you for the question, Global X. Thank you for the answer. Thank you, everyone who joined us. Thank you, our speakers. Yay. And see you guys next time. Make sure you follow Steady State on socials, join our Telegram to ask even more questions, to discuss different topics, to get to know Steady State overall. And see ya.
Okay,
Thanks, guys.
Stay
Thanks,
stable.
Sylvia.
Bye.
Bye.